All right, so my man Lance Roberts at Real Investment Advice writes how to invest in a recession. And again, I'm a big fan of the gents over at Real Investment. Let's see if they did a video on this. They have a YouTube channel. Let's check it out, shall we? Let's click on YouTube and see what we come up with, shall we? Yes, we shall, because I run this website or this channel. So I thought we'd do subscribe to these guys. Could have sworn I would.
Hi, I'm Lance Roberts. Thank you for...
There you go. So let's, oh, here we come. Watch out, boy. He'll cheer you up. Oh, here we come. It's a mind breeder. There we go. Retirement independence. American epidemic. Living beyond your means. Duck inflation. Recession risk. Mustering stable energy prices. What? All right. There we go. Inflation's 3% pay cut. Oh, look, he's punching. All right. He's thinking. He's thumbs upping. That's good. That's good. He's doing that. Worry. He's doing this. Pricing and recession. All right, cool. So I bet that's, when was this article written? Just today. All right, so I'm not sure. Anyway, but that's, you should subscribe. So subscribe to The Real Investment Show. I thought it already was, but I guess I was not. Let's go. You used to be able to look at videos by oldest. I can't. There we go. Just 3 years ago. All right, cool. Why the U.S. cannot decouple from the global economy. All right. All right, good. All right, big fan. Long time, first time. All right. So let's see what we got here. How to invest in a recession. Right here. Have excess emergency savings so you're not forced to sell during a decline to meet obligations. Huh. Josh, that sounds like the barbell. And I'm not saying, I just, look, I agree with Lance. He would say he certainly agrees with me most likely. Never met Lance, don't know him. But 100%, have excess savings. That would be the 3 to 5 years cash, the 4 years cash in the barbell. 100%. So that way you don't have to be forced to sell something to put food on the table. Extend your time horizon to 5 to 7 years as buying distressed stocks and get more distressing. I'm not sure exactly what he means by that in terms of is he looking to profit in a certain amount of time and sell. I'm not exactly sure. Is he saying, hey, look, if you buy something that's way down, go ahead and give it 5 to 7 years before you analyze if that's a good move or not. That's the only thing I can think. I don't buy hardly any individual stocks, but, if I do, I do. And I hopefully don't sell them. Don't obsessively check your portfolio. That's 100%. In fact, I haven't looked at UGI or Exxon in the last couple. I think I looked at Exxon not too long. I don't even remember what I bought for these stocks, actually. But I think Exxon was up to 100 last I checked. Wow, it was at 87, man. Okay, so Exxon's tumbled. All right, so I bought that puppy at 40, I think. Sold it at 65, and it went all the way up to 105, and now it's down to 87. And that's up from freaking 2.23%. So what's causing that? Why that caused a big jump on top of the big fall? I don't know. I mean, literally I don't obsess. I bought UGI, so replace Exxon with UGI, which is at 30. I can't remember what I bought this at. So UGI is at 39.72. It was up almost 3% on yesterday as well, but it took a big chunk loss there. So I'm sure this is only 1 month. So let's go to a year. Yeah, I think I bought it last October. Yeah, I think I bought it around 44, so it's down to 39, and I've gotten, it's paying a dividend yield of, let's see, not much, 3.65, but I'm getting a dividend. It's only got PE of 5.66, so I just can't remember what the debt's. I buy it, I look at it before I buy it, and I buy it, and I sit on it. With Exxon, I said I'm going to take my gains. And my problem is I always sell too soon. That's what my mom said. And it's words to live on, words of advice. You'll never go bankrupt if you always sell too soon. Consider tax loss harvesting, selling stocks at a loss to offset those future gains. I completely agree. If you have a brokerage account, you got some losses, sell them, man. Wait 31 days and buy back if you want, sure. Stick to your investing discipline regardless of what happens. Yeah, I tend to agree with that too. So, I mean, well, I don't tend. I do agree with that. It's like, what are you going to do differently? I mean, remember, the stock market doesn't care about you. It doesn't care, and your stocks don't care what you paid for it. The question is, would you have bought the same thing today that you did 18 months ago if it's down? If the answer is yes, why do anything with it? If the answer is no, then sell it. It's just literally that simple. Would you have bought that stock today, knowing what you know now? Literally that simple. If the answer is yes, then stay. If the answer is no, then sell it, man. And again, I'm not telling you what to do. I have no clue what your holdings are. Don't know, don't care, don't need to know. Don't tell me, as Paul from Pockets of the Future says. Don't know, don't care, don't know, don't tell me. That always cracks me up when he says that. Anyway, same thing. The stock doesn't care what you paid for it. So if you bought it, at Exxon at 100 and now it's at 82, would you have bought it at 82? No. Okay, then you should probably sell it. If you're thinking, I should not have bought that stock. Why? Because it's down. Would you have bought it today if you could? If the answer is no, is that only reason the answer is no because the stock is down? You're going to be a bad investor. That's all there is to it. So let's keep looking here. Once prepared, what investments do well in a recession? A recession is a good time to avoid speculating, especially on stocks that have taken the worst beating. I completely agree. Weaker companies often go bankrupt during recessions, and while stocks that have fallen by 80 to 90% might look like bargains, they're usually cheap for a reason. That's why value stocks are actually riskier than growth stocks. A lot of people don't recognize that. They say value stocks outperform. Not necessarily, but the reason they should outperform is because they are trading at cheaper, i.e. discounts relative to earnings. Why? Because they have more debt. Because they're riskier, more regulation. It could be a million different bunch of things, but value stocks inherently are riskier, which is why if they do outperform, they would, because they're taking on more risk, and risk equals return, we hope. A broken business at an excellent price is still a broken business. That's Motley Fool. I completely agree with that. In other words, chasing what worked previously will likely not be the right choice, man. Ain't that a fact? More importantly, in a slowing economy, fundamentals would become more critical. Therefore, to make money, focus on companies that, A, have consistent earnings over time. I completely agree, man. You don't want fluctuating earnings. You want consistent, that they were able to weather bad and good times. Are dividend payers and avoid high leverage. 100%. High leverage is debt. And they pay a dividend, lots of cash, and hardly any debt. If you can avoid that, you're going to be... Remember, you can't go bankrupt if you don't have debt. Have free cash flow and strong operating margins. All right, so again, we're talking about they're paying a dividend, they don't have a lot of debt, and they have cash. I tell you, cash, dividends, and no debt. I tell you what, man, I'll take those three things over even consistent earnings. I mean, consistent, I say, when I'm thinking consistent is like steady. Now, it can be volatile, but if it has debt, it has no debt, lots of cash, and pays dividend, that's number one. Avoid companies dependent on consumer spending with high burn rates of cash or negative incomes. Well, that's saying don't buy stocks that have no earnings. And 100%, man. Invest incrementally using lower prices to build positions. So basically dollar cost average. Here's what Lance says. Don't forget about bonds that offer a haven during volatile market environments. Yeah. It's interesting. It's like your old buddy Josh been saying that. Now, the irony of it all is we've had the worst bond market we've ever had. Isn't that crazy? Wow. But that's good, because that means the bonds have more upside now than they did 6 months ago. And that's just a fact, man. Now, will that be they have more could they go down more? Sure. The likelihood of bonds dropping more isn't very high, in my opinion. It's just not. Because they're not trading very high prices to begin with, man. They're just not. So, anyway, anything can happen, but bonds look awful attractive to me right now. That's a fact, Jack. All right, love your thoughts. Looks like that. Here's some thunder, so I'm going to get back inside. We'll see you.